Hi, it's Ty the Real Estate Guy, and my goal is to educate those of you who want to buy a home so you can successfully navigate the confusing and often overwhelming process of buying a home. In my 13 years as a real estate agent, I've personally purchased 10 properties. I've lived in some of the homes, I flipped one, seller financed another, and I'm currently renting a few, including one as a vacation rental in Hawaii. As a new home construction specialist, and as someone who has lived in a home I had built for me and my family, I also understand what it's like to go through the tedious process of building a home. I have more than 400 real estate transactions under my belt, so you could say I've pretty much been through the ringer. I'm not bragging, I just want you to know that I'm speaking from experience. I take a lot of pride in what I do, continually educating myself to ensure I'm keeping up with the constantly changing market and industry trends. I sincerely want to be a real estate agent that people can count on to not only negotiate the best terms in their real estate purchase, but to also make the transaction go smoothly, because buying a home should be fun. Now, recently I published a video how to buy a home. Not long after that, one of my subscribers asked if I could go into more depth. So that's why I'm making this video. Today we are taking a deep look into the home buying process. I'll educate you on everything you need to know before you buy a home. And I'll start by talking about how to get a loan and the different loan programs that are available to you. Most people begin the process by saving for a down payment, but usually they don't know how much money they need to save. When it comes to down payments, there are actually several options, all depending on what loan program you end up using. Most lenders will require 3.5% to 20% down based on the final price of the home. The percentage is determined by the loan program that works best for you. When it comes to getting a home loan, most people go with one of two options, FHA or conventional. The Federal Housing Administration, FHA, is a U.S. government agency. FHA is popular because you can get into a home with a lower down payment, your credit doesn't have to be quite as good, and closing costs can be a little lower. I'll expand on closing costs a little later. Now, FHA allows you to put down as little as 3.5%. A fairly average home here in Utah will cost you about $350,000. That means you can buy a normal home with less than $12,000. With FHA, you'll have a higher mortgage rate and PMI, private mortgage insurance. PMI is a fee that's added on top of your mortgage because statistically, you're more likely to default on your loan. You'll also hear people talk about FHA loan limits. FHA places limits on the size of mortgages it will insure. This number varies from location to location, so check with your lender to see what the limit is in your area. If you're a first-time home buyer, most starter homes will fall within the FHA loan limits. A big negative with an FHA loan is that you cannot remove PMI. It will remain for the life of that loan. The only way to remove PMI would be to refinance the home in the future when you have more equity. Another option, and in most cases, I recommend going this direction, even if you need to wait a little longer and save for a larger down payment or repair your credit, and that is to go with a conventional loan. This is the most frequently used loan program out there. Unlike FHA, it's not backed by the government. Instead, these loans are provided by private lenders and banks, which means you'll need to come up with a larger down payment, usually 10 to 20%, though there are other options. With conventional loans, you will have mortgage insurance unless you can put down 20% or more. So on a $350,000 home, you need to put at least $70,000 down to avoid this annoying monthly fee. Mortgage insurance can easily cost you an additional $200 per month. I know that right now you're thinking, how can I avoid mortgage insurance if I don't have 20% down? The hard answer is that you can't. Usually, within a few years of buying the home, you can remove mortgage insurance. This is another benefit of going with conventional instead of FHA. Since homes appreciate over time, and since you pay off your mortgage a little each month, you can often reappraise and show your lender that you now have more than 20% equity in the home, and your mortgage insurance will just go away. Now, as you all know, I am not a lender. I do not know all the finite details of the constantly changing guidelines and rules of this industry, but I can tell you there are many great loan options available. If you're thinking about buying a home and feel like you're ready, contact a local bank or mortgage lender. They'll let you know if you're good to go or not. If not, they'll tell you what steps need to be taken so you can buy a home. They'll be highly motivated to help you because they get paid when you close on a home. They'll also educate you on the loan program that works best for you. As promised, I'll talk briefly about closing costs. Many first-time home buyers are not prepared for this additional fee, and it can be a hefty burden to someone that has worked hard to save for a home. I can still vividly remember the shock and disappointment I felt when I was told how much money was due for closing costs when I purchased my first home. I want to make sure you don't get blindsided like I did that day. If you're purchasing a $350,000 home, your closing costs could be more than $7,000. Your closing costs include things like title fees and insurance and escrow fees. Your lender can tell you what your closing costs will be. Just a quick side note, I recommend qualifying with at least 2 different lenders, as rates and fees can vary significantly from one lender to the other. So why am I talking about loans first? Because getting a loan approval is the first step in the home buying process. As a real estate agent, it's shocking to me how many people want to go look at homes without a loan approval. I can't tell you how often people find their dream home only to learn it's exactly that, a home they can only dream about. When they find out they can't afford that home, they are absolutely heartbroken, and then it becomes a nightmare as they are forced to look at smaller and or older homes. Do not waste your time looking at homes without first talking to a lender to not only see how much home you can buy, but also what your monthly payments will be. I really hope this makes sense. Also, a lot of sellers want to see a loan approval with your offer to purchase their home. If you don't have one, many sellers will ask you to resubmit the offer once you've been pre-approved. During this time, someone that already has a loan approval could buy the home out from under you. There's also a chance you could find yourself in a multiple offer situation. If that happens, and the offers are all the same, the seller will pretty much always go with the buyer who's been pre-approved. If you find a home you love and it's a great deal, chances are others will be excited about this home too. In real estate, if the property's a good deal, time is of the essence. Often the person who gets the home is the one who acts quickly and has all of their ducks in a row. Hopefully at this point, I'm getting through to you about how necessary it is to have a loan approval before you go look at homes. Now, I have to warn you, the process of getting a loan can be tedious. The lender's going to ask you for a bunch of personal information, and then after you've gone through the entire process and you're preparing to close on your home, they'll most likely ask you for more information. There is a very good chance you'll get annoyed, but just stick with it. Look at this as short-term pain for a long-term gain. So, what is the lender going to want from you? First, they'll want permission to run your credit. We'll talk more about credit, focusing on ways you can increase your credit score a little later. They're also going to ask for your last few pay stubs and your last 2 years of tax returns. They'll also want to see the last 2 months of your bank statements. Why are they asking for your bank statements? They want to see your month-to-month cash flow. That's your money coming in and your money going out. They'll also want to see how much cash you have in savings, but mostly they'll want to see that you have enough money in reserves that if you were to lose your main source of income, you could still make the next several months of mortgage payments. Lenders will also look at your debt to income ratio. Debt to income ratio is the percent of your monthly gross income that goes towards paying debts. They'll want to know where the money is coming in and where it's going out. This includes things like other properties you may own, auto payments, credit card payments, child support, and things of that nature. As far as your credit score goes, it can make or break the deal for some of you. For some, it will be bad news, and you'll have a lot of work to do before you can even think about buying a home. For many of you, your credit score will be just fine, and for others, your credit score will be spectacular. If you're one of the fantastic few that have a ridiculously amazing credit score, nice work. Let's focus a moment on how to build your credit. Even if you have good credit, you'll want to watch this video because you can save a lot of money by increasing your credit score, sometimes by even just a few points, especially when you look at what you'll be paying for your home over the life of that loan. So, having a decent credit score is crucial if you want to buy a home. Banks and lenders can determine by looking at your score how likely you are to pay off any debt you've accrued. Your credit score is a reflection of all the loans you've had over your lifetime, a payment history on any money you've ever borrowed. You know, things like auto loans, school loans, credit cards, and the like. If you've never taken out a loan, it's likely you don't have a credit score at all, and that too is a very bad thing. If this is the case, you need to figure out how to start building credit. Many start with a credit card. Lenders rate you based on your credit score. It's just as important as having a good down payment. So what is a good credit score? The number you want to aim for is 740 if you want to get the lowest interest rate possible. Now, before you buy a home, you really should try to pay off any high interest loans. This is usually credit cards, but not always. Having this type of debt will limit the type of loan you can get. People often ask me if they should pay off a car or student loans before they buy a home. Obviously, you should always pay off any debt before buying a home, but always talk to a lender before you do anything. A little debt when buying a home is acceptable, and you don't want to pay off your huge loan just to find out you now don't have enough money for a down payment. Well, because there's so much information to cover, and I don't want this video to be too long, I think I'll stop here. Thanks for watching. To see the second part of this video, where I'll be discussing the actual process of buying a home, please click on the link below. If you found this information helpful, please give me a thumbs up and subscribe to my channel. Thank you.